Good afternoon, everyone. All right. Let me go through the introductions. I was just welcoming everyone to this TradeStation webinar. As you can see, we have our guest speaker already logged in, Craig Bewick. We'll get to him in just a moment. He visits us from the CME Group, and he's the Senior Director of Client Development there. He's going to talk to us about futures options and some of the nuances and details about them and how you can trade them. Some of the things you have to be aware of futures options when your intentions are to trade them. My name is Jesus Nava. I'm the Director of Education here at TradeStation. Always a pleasure to talk about TradeStation's products and technology. Keep in mind that everything we talk about is for educational purposes only, that Craig Bewick is with the CME Group. He's not affiliated with TradeStation. And also that any example that we talk about or past performance is just that. If you need additional details on these disclosures, go to tradestation.com/important-information. I also want to talk to you about our in-person masterclass. If you haven't heard about it, it's going to be in Chicago. Craig, by the way, is going to be there with us doing a presentation on behalf of the CME Group. It's a one-day event in Chicago, Illinois, and we're going to talk about derivatives. So it's going to be all based on options, futures, and futures options. So if you have an opportunity, I am going to share the link right here in the chat for everyone to have, and you can learn more about the details right on that page. And if you have any questions, just let me know here in the chat, and I'll be standing by to answer any of those questions. Okay, perfect. We have Craig Bewick. I'm just going to pass the microphone over to him, but Craig brings in over 20 years of experience talking about futures and options, so it's great to have him. Craig, great to have you after the little technical glitch right there, but we're ready to get started, so the floor is all yours.
Great to be here, and thanks, Jesus. And sorry to everybody for the trouble. We appreciate that you're choosing to spend some of your day with us to begin with, so thank you for being here. I'm gonna share my screen, right, Jesus?
Yes, go ahead and share your screen. You should have permissions already.
Okay, here we go. Let's see if I can get this part right. All right, let me just.
It's coming through. I think it'll work. Yep, it's working.
Yeah, I just got to get it in present mode here. Thanks again. And yeah, I want to plug the in-person Chicago event too. I think it's going to be a great event. TradeStation's got a great lineup of speakers that are experts in the field. I'm doing a thing with Jim Urio, who's awesome. So I would encourage anyone that can make it to that. I think it's going to be a great event. And also thanks to TradeStation just for this opportunity and really for the partnership that we've had with them for decades, really. They've been a great partner as CME seeks to educate the trading public on futures and options on futures. So I'd be remiss not to thank TradeStation for that. My presentation today is called An Option is an Option because we do believe that an option truly is an option. So if you already know your Greeks, like your deltas and your vegas and gammas and thetas and things like that, if you already know what implied volatility means, then you know about 95% of what you need to know to trade options on futures. If what you're trading is, and I'll fully concede that it's more popular, options on stock. There's many more people trading options on stocks, and I think a lot of people don't realize, one, that options on futures exist, and then two, that an option is an option, and that they already know a lot of what they need to know to trade options on futures. And there's some attributes and characteristics of options on futures that I think make them attractive to individual traders and incidentally institutions alike. So with that, I also have a disclaimer. I'm not going to read it word for word. I would encourage everyone to check out CME's educational portal. It's called CME Group Institute. And if you Google CME Group Institute, it'll take you right there. It has material that I would consider 101 level all the way to what might be graduate level work in options and futures and options on futures. So check it out. I don't think there's any such thing as knowing too much. And it's, like I said, I think it's a world-class educational portal on this material. So with that, we'll get started. This is just a quick facts slide on CME Group options. And a lot of times I don't like to put in our volume growth in particular products because I don't think, that because an option is up 10% year over year is a reason to trade. I think there's a lot of reasons to trade options on futures. Marginal volume growth, I don't think is one of them. But these numbers that we saw in 2020, it should actually be 24 versus 23. But last year we saw unbelievable growth in our options volume. If you look, our metals options, which is primarily gold options, was up 84% among individual or what we might call retail traders. Like, that's a big number. And I think what's happened is that as options trading has become more popular generally among retail traders, some of it has, I think, has to do with the well-publicized popularity of quote zero DTs. And I've never liked that term, but the popularity of options that people are trading on the day they expire has led to just increased awareness really of options trading. And I think we've benefited from that because as people got used to trading options, a smaller subset did discover that there's also this thing called options on futures. And we've seen some of that growth, but I think that we're poised to see even more explosive growth as people realize that an option is an option, like the name of this presentation. A couple other things, options on futures are margined using the same what we call capital efficient margining technique that we margin futures with. So it's something we call span here, but it has to do with the fact that futures are inherently leveraged products and the options benefit from that same capital efficiency that futures do. And I'm going to go into a couple of examples of that later on, so I won't get into any more detail now. And then like futures, options on futures at CME are available nearly around the clock 5 days a week. So like our futures markets, our options markets come up, most of our option markets come up at 5 p.m. Chicago time on Sunday evening, and they're open until 4 p.m. Chicago time on Friday afternoon with a 1 hour break between 4 and 5, like our futures are. So I've got a slide later on that kind of underscores why I think this nearly 24-hour access is really important to individual traders. So what I did here was I took the most basic, simple example that I could come up with, just a long call in what we call the E-mini S&P 500 future. So it's simply a near the money or a really close to an at the money call in a future that's the E-mini S&P 500, which is just a future on the S&P 500. Much the exposure would be similar to that what you might get in the the SPY ETF. I took an option that had 4 days until it expired. And so it's a 60.85 call with a future at the time trading at 60.93.5. And at the time I looked at it, and this goes back now, gosh, I guess 6 months ago I did this, back in February and at 1:15 in the afternoon, this particular call was trading with a 13.93% implied volatility. And then you had the associated Greeks that this call was trading at, again, on Monday at 1:15 below. So the option, the midpoint of the bid offer at the time was 40 and a quarter. Delta was about 53, had the gamma that you see there, the Vega theta, and kind of less of a consideration with 4 days left, but the interest rate or the row value is also there below. So what I did was then I took a look at that same option not even a whole day later. So that was Monday at 1:15. I looked at it and it had the characteristics that I just mentioned. On Tuesday morning at 7:20, the S&P future, the S&P really, had dropped by 24.75 points. So what I did then was I looked at that same call and I said, now what does it look like? The days to expiration obviously had decreased by about 0.9 because it was almost a day later. The future price had fallen. And unsurprisingly, given that the futures or the S&P had fallen by almost 25 points, implied volatility had ticked up from 13.9 to 14.8%. That left us with a mid price, again, the price between the bid offer of 26 and a quarter. So the value of that option had fallen from 40 and a quarter to 26 and a quarter. The delta had fallen from 54 to about 43. And then the rest of the Greeks are there. So you might ask, why am I going through this? The reason I'm going through this is to prove that options on futures and implied volatility and the Greeks and everything like that work much the same way in options on futures as they do in options on securities like stocks or ETFs. So what I did here was what I showed you on the previous slide was literally what the market was at. That was, I just got that from the current bid offer and things like that. So I went back. In the next slide here, what I did was I went back and looked at where did that difference in 40 and a quarter and 26 and a quarter come from in terms of options math. So I went back and I did a theoretical rather than a realistic view of what happened to that option. So what I did was I took that beginning delta of about 54 and the ending delta of about 43, which if you average that then was a delta of about 48, and I multiplied it by the price change because that's the delta. So that gave us a theoretical decline in the price of the option of about 12 points. Then I did the same thing with Vega. So we saw that Vega actually, or I'm sorry, volatility increased when the price of the future fell. And the Vega, which led to an increase in Vega of about 2.4, which then, if you multiply that by the implied volatility change, gave you a difference in the price of the option of plus 2.1. So whereas the decrease in price gave you that negative value because of the delta, the increase in Vega, because again, we're assuming a theoretical long position, actually gave you an increase in the value of that option of 2.1. And then the time value. So I took the average of the beginning and ending theta, which was negative 4.7, multiplied it by the days to expiration change of 0.9, and I came up with a negative 4.14. So together, what I did was I said, what impacted the value of that option? Why did it fall from 40.25 down to 26.25 in terms of the Greeks? The delta contributed about 12, minus 12. The Vega contributed about positive 2.1, and the theta contributed a negative 4.14, which actually gives you the same theoretical price, just using the Greeks, as the actual market showed us that next morning. So my point here is this is very basic stuff for people that know options, the delta, vega, theta, and the impact that they can have on the value of an option. It works the same way in futures options, as you already know. So again, this is a very simple example, just a simple long call, but I did that because it is very easy then to explain where the impact of the option value came from as the price of the future fell. The other thing I want to point out is that all of the same strategies that you might be familiar with if you're trading options on securities, like verticals, so like a call spread or a put spread, a strangle, a ratio like a 1/2 or a 1/3, or like an iron condor, they all work the same way in options on futures as they do in options on stocks. And you can see on the left there that 38% of CME Group's retail options volume comes in as spreads. So they're just as popular in CME's options on futures as they are in options on stocks. So you can see, for example, in the equity options there, the EQ, 43% of the spreads came in as verticals. So your call spreads and your put spreads. 47% of the metal spreads, and again, that's primarily gold, came in as verticals. You might be asking why there's the generic spread is the second one listed there. What that is, it doesn't mean that it's some exotic 13-legged spread or something that retail or individual traders are putting together. Generally, that means that it could be something as simple as what we might call a broken fly. So like a butterfly where the wings are not equidistant from the body. So maybe the downside wing is less than, is closer to the body of the butterfly than the upside wing. So it's not necessarily like that there are these really exotic spreads, but there's something that doesn't fall precisely into one of the buckets like vertical strangles, ratios, iron condors, or like butterflies. So it could just be like a slight variation of a standard spread. But moreover, my point here is that these are the same spreads that you're probably familiar with if you're trading options on, on any other instrument. And again, they work the same way in futures options as they do there. The one thing that you've got to learn, and I'll concede to you that it's just something that you have to learn if you want to trade options on futures, is that we call them ticks. So they don't tick, or they're not priced in 100 share increments. They're priced in what we call ticks. And I'm going to get into that. And the way I'm going to get into it is I'm actually going to start by comparing it to the equity world. So let's say you're trading the Spider ETF that I mentioned before, and you're looking at a 548 call, and the price that you see on your screen is 3.77 bid at 3.79 ask. If you're an options trader, you know instinctively that Spider is worth 100 shares of Spider, which means that without even thinking about it, that 3.77 at 3.79 is translated into $377 at $379 because it's that 100 share increments. Futures options, on the other hand, have what's called a multiplier. And to understand that, we're gonna get away from the options for a second. We're gonna look at the futures. So what I did here was I took an example of what we call the micro E-mini S&P 500 future, which is a smaller version of what we call the ES or the E-mini S&P 500. Now, the way that you determine how much exposure you're getting to a futures contract is by using what we call a multiplier. So instead of that 100 shares, the futures contract has a multiplier associated with it. So in the case of the micro S&P, that multiplier is 5. In the case of the E-mini S&P, that multiplier is 50, which means the way you determine how much exposure you're getting to that particular instrument, in this case, the S&P 500, is by multiplying the current price of the S&P. And again, at the time I did this, at least the upper part here, the S&P was trading at about 5,500. It's now, if you look at the bottom there, which I redid today, is about almost 1,000 points higher at 6,400. So if you want to know the notional amount of exposure you're getting, or how much exposure you're getting in the S&P, you multiply 5 times the value, which, let's say it's 6,500, is, what is that, 33, around $33,000 worth of S&P exposure with one micro S&P 500. That means if the value of the S&P goes up by 1 index point, it's a $5 impact to your P&L. If it goes up by 0.25 index points, or what we might call a tick, it's a $1.25 impact to your P&L. Now, to contrast that, if we were trading the bigger one, the E-mini S&P 500, one index point would be worth $50 to your P&L. And then, of course, $12.50 would be a 0.25 move in the price. So if it moved by 0.25, that would be a $12.50 impact to your P&L. But here we're looking at the micros. If we look below, and this is just a screenshot of CME's, the front end, the trading front end that CME provides, called CME Direct. So if you look at that 64.60 strike and you look over to the left, the calls are being quoted at 30.00 bid at 30.25 offer, which means that in dollar terms, instead of multiplying by 100 like you would in the spider because it's 100 shares, you use that multiplier of 5. So in other words, that's $150 bid at $101.25 offer. Now, again, this is not necessarily intuitive like 100 shares of stock is, but it's also not rocket science. It's just one of those things that you have to learn in order to trade futures or options on futures. And once you know it, it becomes second nature. So I've got on this next slide just some of the price increments and some of the major products that individual traders trade at CME. So you can see the two that I just went over. The minimum difference between the bid and offer that the S&P can be is 0.25. So in the case of the E-mini, again, that's $12.50. In the case of the micro, that's $1.25. In the NASDAQ, we have a similar, or actually the same, what we call minimum tick of 0.25. But because in the NASDAQ, instead of a 50 multiplier on the mini, it's a 20, that 0.25 is worth $5. On the micro, that 0.25 is worth 50 cents. And then you can see some of the other major products like the larger size crude oil, or CL, that's 1,000 barrels of crude. So the multiplier is 1,000. So a 1 penny move in crude is going to be a $10 impact to the P&L, where the micro crude is 100 barrels of crude oil. So a 1 penny move is a $1 move or impact to your P&L. So again, these are found on both CME's websites and what we call contract specifications. You can find them on TradeStation's done a great job of making sure that its customers can figure out what the notional, what the multiplier, what the tick size is, and then what the notional value of all of these different futures contracts is. But I will concede that it's just something that you've got to get used to. You've just got to learn. And then once you do, it becomes as instinctive as knowing that an option on stocks is 100 shares of stock. I mentioned before that options on futures trade in this basically in the same hours that our futures do, which is almost 24 hours a day, starting at 5 p.m. Chicago time and ending at 4 p.m. on Friday afternoon, with a 1 hour break each day between 4 and 5. Why is that important? What I did here was I went back and I looked at the biggest volume days that we've seen in our S&P futures. So if it's before May of 2019, that's just the E-mini because we hadn't launched that smaller micro version yet. If it's after May of 19, this volume is a combination of both the mini and the micro. And I said, what were the biggest volumes that we saw overnight? So between 5 p.m. Chicago time, and I think I did 7 a.m. Chicago time. What were the biggest volume days we saw? Well, we saw the biggest one that we ever had was on November 9th of 2016. And if you were in the markets in November of 2016, you know exactly what happened that night. It was the presidential election where we went into that election with Hillary Clinton leading in all the polls. And I think the consensus was that Hillary Clinton was going to win that election. Then the early results started coming in that suggested that Donald Trump was doing well in the exit polls, and the market broke. The S&Ps, the NASDAQ, they broke hard initially on that news. So overnight that night, we traded 2.3, just overnight, we traded 2.3 million E-mini S&P contracts, which was 44% of the total volume we did in E-mini S&P contracts on November 9th. The price range overnight was 132 points, which again, at $50 a point, again, that was the multiplier of the E-mini, was a $6,600 impact to your P&L just with one contract. So I think that underscores how important it is to be able to get at your position overnight. And incidentally, CME actually got an inadvertent commercial that night because Carl Icahn came out in the press a day or two after that election and said that he had left an election party during that night and put on a long position in CME's E-mini S&P 500 futures contracts. And I think he quoted the amount of money he made, like $10 million or something like that. But it was a nice little commercial for CME because we were the market that was open that Carl Icahn could go and put a big position on in the S&P 500 future during the big market move that we saw that night. Some of the other big volume nights that we saw was in March of 2023 when we saw the volatility was injected into the market because of the Silicon Valley Bank failure. So that night we saw 1.8 million contracts trade. In February 28th of 2020, we saw almost 1.7 million contracts trade overnight. And that was right before the lockdowns of COVID. So what's interesting here is that we knew that there was going to be a presidential election on November 9th of 2016. We knew that there was going to be a Brexit vote, if you see below, on June 24 of 2016. We didn't know that Donald Trump was going to win that election and the volatility that was going to be associated with that. We didn't know that even though you had started to hear things about COVID and things like that in February of 2020, we didn't know that whatever happened on that one particular night was going to spike volatility overnight that night. So some of these things are predictable, but some of them aren't. So I think it's really important that you're able to get at your position all night long. And CME options are really one of the only liquid options in the world that individual traders can trade all night long. So I think this slide underscores how important it is because the fact is that, you know, the world economy is more interconnected than it ever has been. So they used to say when the US sneezed, the world caught a cold. Now it doesn't matter who sneezes. What happens in the US affects what happens in Asia, affects what happens in Europe, and around like that. So anything can happen at any time. And like I said, I think this slide does a good job of pointing out why that's important. I also mentioned that options were margin in much the same way that our futures are here, which is what we call a very capital efficient way to deploy your money. So what that means is if you're trading, if we forget about options for a second and you want to exposure to, let's say, the NASDAQ 100 index, you can do it through Qs, the QQQ ETF, or you can do it through the E-mini or the micro E-mini NASDAQ 100 future. So the micro E-mini NASDAQ 100 future has a multiplier, like I just mentioned, of 2, which let's say at today's prices of about 23,000 is notional value of about $46,000 with one micro contract. In order to hold that micro E-mini NASDAQ 100 overnight, CME only requires that you put up in performance bond or margin about 6% of that. If you're going to hold that same exposure in the QQQ, by Reg T margining rules, the SEC Reg T regulation, you'd have to put up half of that or $23,000. A lot of that margin efficiency or that capital efficiency of futures carries over to options. So I just did a couple of real simple examples here. At the time, if you sold an E-mini call, so the future, the calls we just looked at, and again, this was back when the E-mini was trading around 6,000. If you sold one of those, the estimated margin that you'd be required to put up to hold that position would be about $17,300. If you sold an equivalent, a notionally similar position in the spider, the margin that you'd have to put up would be 60,500 for essentially the same amount of exposure. So I think that does a really good job of pointing out how capital efficient the futures are relative to the counterpart in the securities world. And here's another real simple example. So instead of selling what we might call a naked call, like we did in the slide before, here's a short strangle position, which a lot of retail traders or individual traders might put on. So if you sold an E-mini strangle that was 30 days out at the strikes that I've got there, the margin required would be about $13,800 at the time I did this slide. A similar spider strangle, the margin would be about $57,000. So you can see just how efficient you're able to use your money when you're trading futures or options on futures relative to the instruments in the securities world. Now, what I do want to point out is the other way to say capital efficient is that these are levered products. So you are getting inherent leverage with these, which means that you have to be a very disciplined risk manager with your trading, because with all levered products, the risk just goes up as you put less and less down to hold that position. But at the end of the day, I think whether you're a hedge fund, an international bank, a central bank, a proprietary trading group, everyone has capital constraints at some point. And again, the way that futures and options on futures are margin allows your money to go further, they might say. I'm going to skip this one and move on. Here's a tool that I wanted to point out that we've got available. It's one of the simpler tools that CME makes available on its website, but I think it's become more and more important as we've added more and more expirations. So I said at the onset, there's been an increase in trading, and largely among individual traders, of what you might hear called zero DTE options, which is simply another way to say an option that expires on the same day that you're trading it. And the reason that's happened is because exchanges like CME have made options expirations available every day in almost all of its options. So what this tool does, and you can find it if you Google the title that I've got, contract directory and calendar tool. It doesn't roll off, the title of the tool doesn't exactly roll off the tongue, but it's a powerful and simple tool. So what you can do with this tool is every calendar day that you see a symbol that's an expiration code means that there's an option expiration on that day. So if you click on any one of them, it's going to change the information on the right side of that screen, where it's going to give you the option. So in this case, it's the week 1 option in the S&P 500. It's going to tell you the symbol. It's going to tell you the time that option expires. It's going to tell you how many days until that option expires. It's going to tell you that's a European style, so it can't be exercised early. It's going to tell you that it delivers into a future. So essentially, this tool is giving you all of the information you want to know about that option in order to trade it all in one place. And then, because these are options on futures, if you click the tab to the right up on top that says future instead of option, it's going to give you all that same information about the future that option is on, because you want to make sure that you know what future, if you hold that option till it expires and you're in the money, let's say you're long and you're in the money, so you're going to get assigned a future on that. You want to know the attributes of that future as well. All of that information can be found in this one relatively simple tool that I think is a pretty powerful tool though. So again, it's called the Contract Directory and Calendar Tool. As we've added expirations every day in almost all of our options, I think this tool has become more and more important. So I would encourage everyone to check it out. The next tool I want to show, and I actually want to bring this up live if I'm able to here. Again, I proved that I was a bit technology challenged before, but I think I did. So this is a tool that we call CVOL. And what CVOL is a proprietary volatility index that CME has developed. And what it does is, rather than taking the implied volatility of an option of, let's say, the at the money strike, or maybe you're looking at like a risk reversal, so you're looking at like the 25 delta strikes to get a gauge on what implied volatility is in a certain option. What CVOL does is it takes the entire volatility curve. So it takes every liquid strike on that option and it comes up with one volatility number. So it's an implied volatility index that gives you what we think is a very representative value of what implied volatility is, more than maybe even if you're just looking at the or like the 25 delta strikes. This gives you the like a smoothed out version of implied volatility across the curve. Now, there's nothing wrong with looking at the money or the 25 deltas. That's certainly going to be an indicator of what implied volatility is in a certain option. But this tool, I think, gives you a very representative number of what it is. And furthermore, what I think is really powerful about this tool is I can click onto any one of these that you see in front of you. So I picked silver because silver and gold have both been having tremendous moves to the upside lately. So what this does, if you look up here, we're at 1 year. So it gives you 1 year's worth of data, one of the price of gold futures, which is the dotted line here, and then also the implied volatility of gold, which you can see has moved up even in the last week. I'm sorry, we're looking at silver here, of silver, which over the last week has increased dramatically over, what we're at, like 1 year lows, which I think is also interesting, right? Because we'd seen even before this recent move in silver prices, we'd seen a fairly strong move to the upside here, but yet implied volatility down here was trading at a 1 year low. Now we've seen silver continue to climb higher. We've seen gold continue to climb higher. And now we're seeing implied volatility options also recover from those 1 year lows. So that means that the options market is pricing in more movement going forward than it was just a week ago. What I can also do with this tool, I'm going to click off both the price and the CVol, and I'm going to look at skew. So this tells me how high the implied volatility in the calls is relative to the puts. So you can see a week ago or so, maybe this is a little bit more than a week ago, we saw the puts had been bid relative to the calls as this line had gone down to, again, near 1 year lows. So about whenever that was, August 15th, we saw the puts trading as high relative to the calls as they had in almost a year, if you get rid of this spike lower here. Now what we've seen over the last, or since, I should say, since August 19th, we've seen this recovery in the calls relative to the puts. The calls have been bid up relative to the puts, which means that the options market is positioning itself for possible further upside move in the price of silver. Now, of course, that doesn't mean the price of silver is going to go up. We all know that trading's not that easy, but it does tell us where the options market is positioning itself. And then the final thing I'm going to point out here is convexity, which is a measure of how high the implied volatility in the out of the money options is relative to the at the money, or in other words, is the market long the wing. So the higher the convexity means that the out of the money options volatility is trading high relative to the at the money volatility, which means again that the options market is pricing in the potential for outsized moves in either direction. If you look at convexity, doesn't talk about calls and puts, it looks at the proximity to the at the money. So again, and then I can change this. If I go up here, I can look further out, like at 3 years. So it's very valuable information. And I don't know of a lot of sources where you can go, and this is available for free, by the way, on our website. I don't know of a lot of places where you can go to find this much historical implied volatility data and skew data and convexity data for free. So to me, it's a very powerful tool, and I would encourage, everyone on the webinar to check that out. Again, it's called CVol, and you can get to it by cmegroup.com/CVol. So it's as simple as that. And that's about gonna wrap the presentation. Got to move this down real quick. The only other thing, we actually have a ton of options analytics tools available on our website. The URL is right there. It's cmegroup.com/quickstrike, and that's quick without a C. And I would say there's probably, if you go back 20 years, the amount of software that's out on our website for free at QuickStrike probably would have cost $10,000, $20,000 like 20 years ago. We make it available for free. We want everyone to go check that out, become as educated on our options as you can. And so I would encourage everyone to do that. There's just a ton of information out there. And that's all I had. I'm here for some questions. I'm going to stop sharing here. I see Jesus is back on the screen.
You have access to the chat? I think there's a question there.
Let me take a look real quick. Yeah, it's a great question. I love this question because that's kind of what my presentation was about. Do covered calls or cash secured puts work the same way for futures options they do for stock options? The answer is generally yes. So if you're long, let's say the S&P 500 future, and you want to turn it into a potentially income generating strategy, you can sell an upside call against that futures position, collect the cash, and then it's going to work much the same way a covered call in the spider might work in terms of pricing dynamics and things like that. So the answer to that is the simple answer is yes. And go check it out because, like I tried to show at the beginning of the presentation, the options math works much the same way.
Somebody's asking about the archive. The archive is going to be posted in the Futures Education Center. It'll take us a day or two to get the content routed through our compliance department and approved. But once that's done in a couple days, we should have the archive posted in the Education Center. Just make sure you scroll down to the bottom of that page. That's where we keep the webinar archives.
Yeah, and I might add, just because I got the covered calls question, that when I mentioned this, if you're doing a risk-defined strategy like a vertical call spread or vertical put spread, and obviously if you're long or short, it's going to depend on whether you're collecting or you're being debited, but that sort of that risk-defined nature is going to be the same in a futures option as it would in a securities option. And I know more and more individual traders are using strategies like that where you can define how much your max loss or max gain when you put a position on. It works the same way in options on futures. I thought that was worth pointing out as well.
Yeah, pretty cool. So Craig, I think we covered all the questions in the chat. Platform question. If I'm assigned a future, where is that future deposited? Not in Futures Plus. That's a great question. So, and for that, I would recommend you contact our trade desk. They would be more informed regarding what happens when you are assigned, where the funds are deposited, especially if you're trading with TradeStation, they would have all that information. I would contact the trade desk for that.
It's a great question, though, because and again, that's just one of the things that you've got to learn with options on futures. Most of our options are going to be deliverable options, such that, and I think I did mention this, such that if you're assigned or you exercise into a position, you will then have a futures position that you then have to manage. You could, of course, if you get assigned a long future position, you could, of course, sell that and get flat. If you're short a future, you can buy that back and get flat, or you could manage the position, which a lot of people do. But it's a very good point, and it's worth underscoring. That is one of the tenets, one of the characteristics of most of our options on futures.
Yeah, Kurt's question there about our
Yeah, so Kurt, that's another great question, and it depends on which option you're trading. And again, because I'm being very frank here, some of it's not that intuitive, and it's why it's in your question is exactly why I brought up that contract directory tool. And the question for everybody is, are futures options European style for assignment? A lot of them are, but not all of them. And even within the E-mini S&P options, almost all of the options are European style, except we have 4 times a year. And this is a legacy thing from when we only had 4 expirations a year in March, June, September, and December. So we have 4 quarterly options that are actually American style, and every other S&P option is European style. And again, I can see that this isn't intuitive to people. It's why I think that calendar tool that I showed is so important, because if you look at those 4 Fridays, the third Friday of each of those 4 months, you'll actually see 2 options that expire on that Friday. You'll see the weekly option that expires in the morning, and you'll see that quarterly option that expires in the afternoon. I'm sorry, I reversed that. The quarterly option that expires in the morning and the weekly option that expires in the afternoon. And you want to make sure you know what option you're trading when you're trading futures options. And again, so that morning option is American style. The afternoon option would be European style, as are the Monday, Tuesday, Wednesday, Thursday options and everything else. So it's a great question. Check out either that calendar that I showed or the contract specifications are going to tell you exactly whether an option is European or American style. You're on mute, I think.
I do that all the time.
I couldn't even log in earlier. So.
Thank you for letting me know. I was just talking about futures margins. If you're looking for futures margins, just go to tradestation.com. You'll see pricing at the top. Hover over pricing and you see all futures margin rates there. The CME website has a great calculator to calculate futures options margin. I would recommend that you go there if you're wanting to look at how much a particular options futures position would cost you.
I think that's a great point because options on futures aren't easy to figure out the margins on. But Jesus mentioned we have a tool, it's called CORE. So if you Google CME Group Core, it's going to bring you to this interface. And again, this is out there for free. I'm also gonna concede that it's not the most user-friendly piece of software that CME makes available. But if you click around enough, you can get to a point where you can input a theoretical position that you're looking at, and it's gonna spit out exactly what the margin is. And you can combine options and futures with that tool. So it's gonna give you exactly what your margin is gonna be. It's a powerful tool. I'm just gonna warn you so you don't get frustrated. You're gonna have to click around just a little bit to figure it out. And we're gonna work on a
Yeah.
more user-friendly or at least a tutorial for that tool because it is a powerful tool.
Yeah, there are some webinars that we've done with Brandon Wendell that are in the Futures Education Center where he shows how he uses that tool, the CME core tool, to calculate futures options margins.
Great.
So please visit the Futures Education. You'll find those webinars there as well. And that's where the archive of this presentation is going to be posted for Bill that is asking. I'm going to remind everyone here that we have the in-person masterclass. Craig is going to be there in person. You can connect and network with him face to face. It'll be a great opportunity for us to meet and just get
Yep.
together for an
I'm going
in-person.
to answer this last question, Jesus, because I get it
Yes.
all the time. So the question is, options on stocks are usually 100 are worth 100 shares or on 100 shares, and that's true. But options on futures are for one futures contract. That's absolutely correct. And what trips people up is that it is on only one futures contract, but that futures contract has a multiplier. And that's where it's that one. It's again, we haven't split the atom there, but it's just not intuitive. So you've just got to learn that even though that futures, it's only on one future, it's
Mhm.
the futures price times whatever that multiplier is the amount of exposure that future gives you. And it also means that multiplier is how you would convert the points that you see on your screen for futures into dollars. So it's a great question. I get it all the time. It just takes a little bit of clicking around and kind of looking at it. And all of a sudden you're like, oh, that's so simple. But if you don't know it, you don't know it. And so that's exactly how that works.
Excellent. Great. For the masterclass, please don't forget to use your promo code, $100 discount for the registration fee. And I think that wraps it up, Craig. Thank you so much for joining us, Craig. It's great information, as everyone pointed out. I also want to thank everyone for taking time out of your schedules and being here in this TradeStation webinar. Please check our events calendar for upcoming sessions, and we're looking forward to having Craig again in one of our future sessions also. Craig, have a great
Yeah,
afternoon, everyone,
my
too.
pleasure. Thank you very much to everybody.
Goodbye, everyone.